Great, thanks for having me, and I am using a mic, though I feel a bit strange doing this, but my voice is starting to disappear after this is our 6th session. So my name's Simon Quilty. I'm a meat and livestock analyst, but I also am a broker, a trader of meat. I mainly source meat out of Australia, New Zealand and India. And India is actually my #1 place today, in which I'm doing about 4 or 5 containers a week out of India, mainly into North America, but we trade or broker into Japan, into Korea and a few other destinations. On top of that, I also am involved in what's called swaps, derivatives, and most of my customers are in North America, and that is almost like thinking of shares in terms of it's all paper trade, but the whole purpose of that is offsetting risk for large end users. So people like Texas Roadhouse, which is a huge steak chain, Burger King, McDonald's, they're the kind of people I deal with, and I've got a company I work alongside in North America called RCM. They're a brokerage house. And then the third or fourth part of what I do is I have got a subscription business with a company called Global Agri-Trends. And each week we put out 2 or 3 updates on the markets. Our, I guess, flagship is we do a Monday morning webinar, and it's North America and us. And we're at it about global events for the last week. And it tends to last for about 30, 40 minutes, but it gives you the latest updates of what's going on globally from both an American point of view and Australian point of view. And they are our largest #1 competitor when it comes to beef globally. So it does make for interesting listening and watching, I think, every Monday morning. So without any further ado, let's get straight into it. So the expression bringing home the bacon, well, it really should be reading bringing home the beef and lamb. But bacon is there for a reason, because a lot has gone on in China in the last 6 to 8 weeks when it comes to African swine fever. They've had another resurgence of African swine fever, and it's enormous. So if you remember, I think the last time I was here, we spoke of African swine fever, the outbreak in August 2018. At that point in time, China had had 430 million hogs in their country. Half the world's pigs reside in China. They did. 19 months later, 2 years later, 50% and more went. They lost 215 million pigs. And as a result, global meat prices rose, demand out of China went ballistic, and the world changed as we know it in terms of meat trading. There's been a lot of other things go on, and today we'll talk about the impact of South America and what it did to our markets, and we'll talk even on Wagyu, on high-end grain-fed, and on lamb as well. So we'll cover a lot of topics today. Getting here was a challenge. I came from Wangaratta, and that weather cell on the right there was not easy. I came on Friday, and that's what it looked like. And I was driving up the mid-coast because I had a cousin with me, and I was trying to deliver him to Lennox Head. Well, it was challenging as the weather got worse and worse. And come Saturday, we stopped at Old Bar. We couldn't go any further north, we couldn't go west, so eventually we parked ourselves in a cabin in a caravan park right next to the sea. And the next morning, we woke up, and that was on the beach. So, anyway, you're never far from the business, are you? Even when you don't want to be. So, the local surf life-saving came to the rescue. I think it's slightly out of their job description, and fortunately, no one had to give it mouth to mouth. So, anyway, it was a dramatic start to my trip. We decided then to head back south, so back to Maitland, over to Scone, and eventually we got to Tenterfield for the first talk. Can I tell you, that took 18 hours. It's quicker to get to New York, trust me. So it's been a dramatic start. So instead of just kind of going through the same old, in terms of trying to explain what goes on, I decided to focus on about 5 or 6 what I thought were really interesting things that have happened in the last 12 months, things that mattered to your business and to me, and to try and show you how and why they've influenced what we've seen in today's market and what it all means going forward. So first of all, COVID-19, absolutely critical in terms of demand, in terms of supply. African Swine Fever and the most recent outbreak, just in the last 6 to 8 weeks. China bans Australian meat processing plants. That is very familiar to all of you, I'm sure. We have 8 plants in Australia that are now ceased their licenses and now they can't ship to China. South America swamps global meat markets. And some other factors we're going to touch on. La Nina, bird flu globally, US hit safeguard in Japan, foreign exchange, and the super commodity cycle. And then Australian beef herd, the sheep flock rebuild, and then the livestock forecasts. As Brent said, we'll do that after you've had afternoon tea and a little snack to eat. So, let's talk about COVID and its impact globally on beef demand. So first of all, we've had the rollout. It's in progress as we speak. Worldwide, there's been 362 million inoculations so far, and it's rising. In America, one of our key markets, 108 million inoculations so far. China, 52 million. And then you've got the EU, India, the UK, Germany and Brazil with 50 million, 30 million, 26, 10 and 5. It's those first 2 at the top that really matter to us. That's China and the US, because they're 2 of our most key markets. So the sooner they get up and running in terms of inoculations and they get COVID out of the system, the sooner the market can get back to normal. So up till now, it's been the food service sector that has suffered the most. And by that I mean the white cloth restaurant trade, for example, the fast food sector, for example, whereby a lot of Australian meat ends up in those parts of the market. And when it suddenly collapsed and stopped because people had to stay at home, they couldn't go out, then suddenly the world changed and a lot of those traditional outlets that we know of suddenly shut down. So much so that in the US alone, 17% of white cloth restaurants have shut permanently since COVID-19, never to reopen. 117,000 businesses. And to us, what really matters are that high-end cut, like tenderloins and like lamb racks, that are so important. But the other area that really suffered was the cruise line industry. As you can remember, there was disaster everywhere as everyone kept falling ill on cruise lines, and that went to nothing. It really stopped completely. And that's absolutely critical in North America for selling lamb racks. Half of Australia's lamb racks go into the cruise line industry, along with shank meat and a couple of other key items. So not only was it the cruise line industry, but the airline industry as well came to a standstill, as we know, globally. Also really important outlets for that high-end meat that goes into those 2 markets. So it's been a difficult time in terms of food service. So what about the impact, though, when it comes to plant-based alternate versus meat? So as you're probably aware, there's been this real push for the health-based part of the industry, both in meat, but also in plant-based alternatives. And I just wanted to try and put into perspective for you how big a deal is this. So I'm talking about, fake meat, as we've been calling it of late, but, the Impossible Burger. You've had, just this week, the announcement in Canada that Burger King is going to have the Impossible Whopper, as of April, now being distributed throughout all of their restaurants in Canada. So it genuinely is alive and well, but in reality, when it comes to regular meat like chicken, beef and pork, $84 billion worth of turnover revenue, sales worth through the retail outlet in America came from our traditional meat in the last year or so. Down here, that is the plant-based proportion of the business, all right? That is less than 1% of total sales so far. It's not to say we're going to get complacent. I'm just letting you know that proportionately, it's nowhere near what you would think it is if you read the papers today. Today you'd be selling half your farms thinking, we're switching to plant-based. Forget it, beef's over. Well, it ain't the case. It's less than 1%. It's not to say in the future that they will not gain more market share, because no doubt they will. But right now, just so that you won't panic, it's that little dot there. So let's though talk about, sorry.
With that plant-based meat, how much of that is going into beef alternative products versus pork and chicken products? Because most of it would be replacing the grinding beef in burgers.
Not necessarily, but so you've got meatballs in cabinets. I mean, it goes through a whole vast array of different items. So I wouldn't just make the assumption that we're talking about burgers, because that proportion was through retail outlets, grocery stores, which if we were included though, the whole fast food sector, it would look a little different. So to answer your question, don't assume that that is just hamburgers. This is through retail outlets like grocery stores.
Your big circle incorporates pork and chicken as well.
Correct.
So I'm just trying to compare apples to apples though.
And beef.
Given that we're not...
Correct. But keep in mind...
So we don't really care about that.
That's true, but plant-based is not just replacing beef, it's replacing chicken and pork as well.
So that's why I was wondering, is it
It encompasses everything, and it's only in the retail outlet. But it's a good question. So let's talk about how the makeup of the market is. So right now, in terms of meat consumption, or what proportion do meat eaters make up of the market, it's 81%. Flexitarians make up 12%. 4% is vegans or vegetarians, and pescatarians make up 3%. Pescatarians being those that eat fish only. And vegetarians, or the vegans, they have sat at 4 to 5% for somewhere between 15 to 20 years. That market hasn't changed. Once again, if you read the papers, you'd think the world was being taken over by vegans. That has not shifted in all that time, 15 to 20 years. But it's the flexitarians that's the most interesting part. And what is a flexitarian? Is that something you do down at the gymnasium? Not quite. Flexitarians are people or consumers that have chosen to eat something for, you might say, whether it's the environment, whether it's animal welfare issues, whether it's due to carbon footprinting, whatever it is. But they are very conscious of all these other, I guess, matters that they see influencing the world and the environment. So they are very sensitive to other factors. So should there be some situation like African Swine Fever and they said, oh my God, these diseases are out of control, I'm not eating pork. And they will switch across to beef or to chicken, or they'll go vegetarian. And a month or two later, they will decide, or something else will happen, and they hear a great good luck story, for example, like Hewitt Cattle, who have done this amazing thing with carbon. And they've said, I'm back eating beef. Gee, they're becoming carbon neutral, that I really want to support the industry. So they are what we call at 12% flexitarians. And that's the portion of the market that is growing fast. Within 5 years, it's likely to be at 25%. Now, do you think that it's going to take market space away from vegans and pescatarians? No, not at all. It's going to be here, the meat eater, that shifts across into the flexitarian. So it's market ground that we are going to lose. It's there to be lost. There's nothing to be gained. But it does highlight the importance of doing, I guess, a lot of these initiatives, which at times you may wonder what's the real benefit. Well, some of it, or a lot of it, will be related to holding on to customers like flexitarians who are looking for an excuse to move away. So that's what I call one of the danger signs on the horizon. It's not to say they're not eating beef right now, there's a good chance they are, but you've got to be just really careful that they could easily move away if given the right excuse, the right reason not to eat beef. So, this is a study called The Power of Meat, and it was done during COVID-19, but particularly during that period of around about March through to July, in which COVID was particularly rampant throughout North America. And what was interesting is this push for health products, health meats. And so what we call them is claim-based meat products. And at the time, the growth in that area has been quite phenomenal, and it suddenly jumped to around about 15% of overall meat sales because people had a genuine desire or belief to eat healthy foods. So let's look at really what happened then. Grass-fed consumption, or dare I say growth in sales, jumped year on year 64%. So that's grass-fed, which includes the Never Ever programs, it includes organic, etc. So the Never Ever program jumped 74%. That is beef with no antibiotics and with no HGPs. And then you had the area of organic that also jumped 52%. The clear message is that the consumer is becoming and has become very health conscious. And from an Australian point of view, we have a comparative advantage when it comes to grass-fed production and meeting the needs of this market. In America, 90% of all cattle are on feed for around about 150 days. In Australia, we only have 30% of our production comes out of grain-fed. So, to me, this is an exciting area that's starting to grow, but it's very high-end and it's very niche, but it's a growing market in North America. So then let's look at January sales only 2 months ago and what went on in the US retail sector. So fresh beef sales year on year has jumped 19%, which is pretty damn good. So there is this ongoing huge demand for meat products, but in particular beef in North America. This has been one of the spin-offs from COVID-19. As people went home to eat, they were opting for beef in more ways than anything else. But on top of that was fresh lamb, up 30%. And lamb, to me, is one of the real success stories of COVID-19. And we're about to talk about how and why it has become such a success story. So here are the sales growth quarter by quarter over the last year. Just here we've got the third quarter of 2020, and the lamb is this purple line at the top. And in the third quarter, it was up 30%, lamb sales. In the fourth quarter, up 33%, and 30% in January that just passed. And in beef, it also did pretty well, up 22%, 18%, and 19%. Those were two of the biggest winners still over the last year, as there was that enormous switch across to retail because people were cooking from home. And it's thanks to e-commerce that has seen such this evolution, and in particular in the lamb sector. And things like HelloFresh, companies like that have really made a difference. So is everyone familiar with HelloFresh? Let me explain what it is. A box arrives after you've ordered it online at your doorstep. And in it, for a family of 3, is the meat, the vegetables, the sauces that are to go with the cooking, and the recipe. And it's perfectly portioned in the right way, so there's no wastage. And the eating experience is fantastic. It's almost like having a restaurant experience at home, such as the tasty meals that come out of it. So we had it for 3 months ourselves during COVID. And I've got to say, it's a revolution. Why? Because it's educated the public. One of the biggest barriers there was for lamb in America was it's expensive, and the public didn't want to take the risk on buying it because they didn't know how to cook it. And now they've learned how to cook it through the likes of HelloFresh. They've educated the public through e-commerce, through this clever system of delivering exactly what you want. You get a choice at the start and you pick the menu, and every meal is prepared for that week. And lamb was a big part of that. So education is one of the amazing things that have come out of COVID-19 and has taught the public how to use, how to cook expensive cuts that in the past they might have not bothered with because they just simply didn't know what to do. So remember those sales figures. Lamb was up 30 to 35% during the last 3 quarters. They're phenomenal growth figures. So here's what happened with the US retail and food service sectors. So these are the sales or spending that occurred in billions. And you can see that during COVID, during that period of March, April, when the world fell apart and people had to stay at home, the food sector collapsed. And at the same time, we had the panic buying within the supermarkets, and retail went through the roof. And suddenly everyone was trying to buy in the supermarket and take it home to eat. And then we've had this gradual improvement in food service, but most of that is not because of the white tablecloth market, it's because of the fast food sector. People got better at going to McDonald's, to Burger King, pulling up, getting what they need, and driving home. So almost from an Australian point of view, there's a good luck story there, because so much of our meat goes through into the food service, and in particular, the fast food sector. Lots of grinding meat from Australia ends up. It's difficult to get access to the retail sector because the US is dominated by 4 large meat processors and everything goes out fresh. So just to highlight though the importance that the food service sector is on the rebound, but the white tablecloth sector is still struggling. So let's look at Costco. And I'll just grab a glass. So Costco is a phenomenon in the US. First of all, you've got to join up to the membership of Costco. They make $3 billion a year just out of people joining up. The privilege to buy there. So once you're there, they also make additional money, dare I say, out of the food that is, or the grocery items and everything that are sold. But it is quite unique because they have such a vast array of things and everything's bought in bulk. And it's not often you can buy a chicken and next to it is a $170,000 diamond ring being sold. But that is such the vast difference of things being sold by Costco. So they are a unique retailer and it's all about moving volume. But here are their figures. So for the second quarter, they saw a 76% increase in online sales. And in terms of profit, last year versus this, or the second quarter versus the previous year's second quarter, it's pretty similar, 950 million compared to 930 million. But there's been a change in the way they've got that revenue. Here, with same-day grocery delivery, that is up 450% within America. That's a phenomenal growth. And they have been reporting, or the revenue gained due to larger baskets being bought, which has jumped from 8.5% to 12%. The point being is that people don't go to the supermarket as much, but when they do go that second week, instead of every week, they're buying a lot more. And once again, the meat sales were the biggest winner in terms of the growth at Costco. So has the fad of online business likely to stop due to the vaccination program? Is this just a one-off deal, and once that vaccine gets out there, it's all over? Or has there been a structural change in the market? And I think the answer to that is the latter. I think what we did with COVID is that we were always going to have e-commerce. But what would have taken 10 years took 6 to 12 months to put in place. We've gone that far, that quickly, and it's extraordinary in terms of how the structural changes come about. So why is that so important for us? It's because, as I said earlier, the retail market in America is dominated by 4 major processors. But for the first time, we can get around that, and Australian beef, Australian lamb, we can go direct to the consumer thanks to e-commerce. I think it provides enormous opportunity for Australia in that market. And the same's happening all over the world. So Japan, Europe. So the US is just a great case study to talk about some of the trends that have evolved here. So it's the economy, stupid, it's the economy. The words of Bill Clinton. And what I'm looking at here is the GDP growth for last year, which, as you can see, China was at 2.3%. The US, Japan, Korea, Indonesia, Malaysia were all negative. Minus 3.5, minus 4.8, minus 1, minus 2, minus 5.6, all negative. It was a tough year. But as we move into this year, 2021, the IMF, the International Monetary Fund, is talking of a phenomenal 8% growth in China, a 5% growth in America, and Japan and Korea at 3.1. And we've got Indonesia at 4.8 and 7%. This is what we call the bounce back effect. This, after a disastrous year last year, we'll see a lot of consumers, countries throw off the shackles of COVID and get out there and start spending. And I think food, and in particular beef, and we've already seen in the January figures that things are already moving in our direction. I think this points to strong demand for beef sales and lamb sales in the coming year, if not longer. There is a question mark over China, and we can chat about that later, and whether it's actually more like a 6%, and in actual fact, whether the US will jump to 8%. As far as I'm concerned, it doesn't matter. We service both. If one fires more than the other, we just ship more that way. Both of them are critical customers to us. It doesn't matter. We're the winner, no matter what the outcome is. The important thing is that there is a bounce back effect after COVID. And this year is when it's going to happen. So let's put it in perspective. Here's the Australian beef exports for the last year. We've got a fall of 16% in America. In Japan, we've got a 6% fall. Korea, it's on track to be normal, it was, and a massive 35% fall in China. So overall, the fall is not completely surprising once you think about the rebuild that started last year in 2020. Production was down in Australia, so lower production, lower exports. I think what's critical here is what's gone on here with China, a 35% fall. Several reasons drove that. One, 8 abattoirs couldn't get access to China anymore. That does reduce capacity into that market. But secondly, is the impact of Brazil and Argentina. And we're going to talk about it in detail, but how they swamped the world with cheap meat. And that drove prices down in China like you've never seen before, and simply from an Australian point of view, it was too cheap. So meat was not shipped there anyway. So let's look at lamb. So here are the key markets. You've got the US actually going up in lamb, you've got China falling 11%, and you've got the UAE that fell 15%. That's our third largest market. But as you can see, the US and China absolutely dominate the lamb market. And what's so interesting is that in actual fact, the US exports that we sent from Australia of lamb went up last year, not down. Even though production was down overall, but somehow the US gained 3%. And I can tell you why, because we showed you at the start, that 30% increase in those growth in sales. This phenomenal demand for lamb actually saw the US find new markets within the retail sector, with other parts of the US, and actually lifted growth. And that is with 3 sectors out of the picture. That's the airline sector, the cruise line sector, and the white tablecloth industry. So what's the message going to be once everyone gets the jab in America, they get out eating, and those 3 markets get going again? And you've got new markets. There's just not going to be enough lamb to meet all their needs. To me, that is the most exciting story of all, is that they found new markets for lamb, and on top of that, once those other industries get going, it looks like a really promising future. So, African swine fever. So in the last week or two, the Chinese government came out with this. In November,
With your prices there, is the...
They're not prices, those were volumes.
No, but with the Australian prices being some of the dearest beef and close to some of the dearest lamb in the world, is that going to affect any of those things?
Sure is. But we will get into that and explain what happened, because it's not as simple as that. You have a high end of the market and you have a commodity end of the market. And once we pull it all apart, it may make a lot more sense to you. So, China came out last November and said that at that point in time, they rebuilt their herd from that massive loss due to African swine fever back in August 2018, where half the losses were gone within a year or two, to 90% rebuilt in November. And then a week or two, about a month ago, they've come out with this, saying that by June, that within 3 months, they will be back to 100%. Well, it's complete bullshit. It's rubbish. And it's important to understand why it's rubbish. Because once you understand that, you suddenly get a feel for how crucial and how much demand and the lack of protein there is globally that's coming fast. And it all happened in the last 6 to 8 weeks. So I'm going to talk to you about the anecdotal evidence, and then we'll talk about the market evidence. And at the end of it, it's overwhelming. There's a huge problem in China right now. So, as I said, it's rubbish. So, a second wave of infections due to 3 new viruses has removed potentially 7 to 8 million sows. This has likely to set back the rebuild by years. So if you take out 7 to 8 million sows, and most sows produce twice a year, and on average they produce 8 piglets or every time. So 7 8s, 56. 56 million hogs. Double that, 112 million hogs to be taken out of the system over the next year. It's a lot. So even their own people are saying it's bad. So COFCO, which is the buying arm of the government, so they have a private little buying arm that they direct. It's not that little, it buys a hell of a lot of meat on behalf of the Chinese government. So one of their analysts from COFCO Futures said the damage caused by the epidemic this winter was much more serious than last year. He then went on to say that an estimated 20% of sows in northern China have been impacted, and that in southern China, a 30% amount has been impacted. And then Yongyi Consulting, an independent Chinese consulting group within China, said that the December-January sow inventory was down, and that they believe now, due to these recent outbreaks, that the inventory is now 37% below what it was pre-ASF. Well, that's a hell of a lot more than what I'm saying. That blows out my 7 to 8 million sows that I'm talking about. The point is, there's a lot of uncertainty in terms of people within China about what the government's saying. So let's go to the market evidence. Well, before we do that, so here is part of the problem. They're not hotels that you want to stay in. They're full of sows and they're full of hogs, okay? And this was the solution that the Chinese were to have to fix the problem. Because land is tight, so they went up instead of going out. And in each of these are housed thousands and thousands of hogs and sows. The problem is, they're highly concentrated. And these three virulent strains are these three strains are very virulent. No different to the UK COVID-19. It's highly virulent. So, 2 of them were man-made. And why do we know that? It's because they're missing in their genetic structure genes. And that's a clear sign that it was man-made. So, it sounds a lot like what happened in Wuhan. And the third one is a natural variant. And the take-home message is that the solution now is the problem. It's just absolutely gone straight through these super complexes. Highly virulent. Okay, onto the metrics. So here's the value of China piglets today. It sits at 98 renminbi per head. Pre-COVID, it was at 25 renminbi per head. So today, they're 4 times higher in price. But yet, they're going to be at 100% in 2 months' time. How's that? Why would they be 4 times higher if in 2 months' time, they're back to normal? In reality, the question is whether it will actually surpass the last peak. In actual fact, is the problem today even greater than what it was? Let's look at the daily China hog price. Once again, before ASF, it was 10 to 20 renminbi per kilo. And today, it sits at 30 to 40. We're talking 2 to 3 times higher. This is the value of hogs in China. What it means is there's just not enough hogs in the system to feed all the people because they've been lost due to the disease. So once again, how the hell are they that close to a full rebuild when you've got hog prices almost at record levels again? And let me explain to you what's gone on here. So you see this drop here. That's happened over the last 6 weeks or so, 8 weeks. And we call that the rush to the door. And what do I mean by that? I mean the farmers are looking to sell those hogs before the disease gets them. It's panic stations, because you want something for them as opposed to nothing. Even if they're half the weight of what they should have been, even if there's nowhere near ready to be finished, it doesn't matter. Just sell them. Get something for them. Otherwise, you're going to be without anything. It's called the rush to the door. So what's the net effect of that? Well, I can tell you now. Expect a pretty sharp rise in prices, because there's going to be a hell of a lot less hogs in China very soon, because they are liquidating fast to try and avoid the disease. So not only have you got the losses of the sows, you now got the market panicking and rushing to the door. Things are tightening up in China in protein. And then we've got the breeding sow prices. So here we are today, sitting at 75 RMB per kilo, and pre-ASF was 30 RMB per kilo. And I can tell you now, that's going to go higher. Why? Because I've just told you, 7 to 8 million sows are gone in the last 6 to 8 weeks. There's going to be a tightening of sows, and with that, their value and pricing will go up. And here's the domestic prices for you of beef, pork and poultry. Beef is now sitting 42% higher than what it was pre-ASF, and pork is up 134%. Nothing is telling me there that they've suddenly back to 100% rebuild. As I said, I think the evidence is overwhelming. But I'd also want to show you an interesting point on this graph. Look at the value of poultry. It is really almost flatlined during the whole thing. You can see that pork jumped because of the lack of it, and beef has become a critical part of the menu or the makeup of the diet of the Chinese. And it's seen as the elite meat to have. So what I find fascinating is poultry is seen as the poor man's meat, and that during all of this, the demand for poultry still remains very flat. So to me, it is not the threat in terms of, China suddenly being overwhelmed by poultry to fix the problem. Unfortunately, it's just not seen as, it's seen, as I said, as the poor man's meat. So beef continues to be a critical part of China's solution to this protein deficit, along with pork. So here are the import figures, and this is their way to fix the problem, at least for the short term. So in 2017, if you added up all the lamb, pork, beef and chicken imported, it was 2.7 million tonnes. Then we had African swine fever in the back end of 2018, and then the numbers started falling dramatically. So they had to import more to fill the protein deficit within China. And so imports got to 5.2 million, and then in 2020, it was 8.8 million tonnes of imported meat filled the hole. And what do I think is going to happen this year? Well, that's the USDA figure there of 8.3 million, the US government's forecast. In actual fact, that was pre this last 6 to 8 week outbreak. I think we're going to see that jump to probably 9.5 million tonnes this year. So 3 times the volume of imported has occurred since 2017 to fix the problem. And that is not going to go away. In actual fact, the needs are getting greater.
What's the thought? Do you think it's possible that China will get rid of it?
African swine fever?
Yeah.
They've been trying for 2.5, 3 years or so, since August 2018, and they've had no luck since. I mean, they keep saying they've got a vaccine waiting to happen, but it ain't happened yet. And so's America trying, and Vietnam and every other place that's got it. America doesn't have it, but they're working hard at trying to find a vaccine as well as a preventative measure. But no, I think it's been a challenge. I think it's a really complex virus. And the fact that it's already mutated and found to be even worse and more virulent makes the challenge, I think, even harder. So, China bans Australian plants. So, in the last year and a half or so, we've got 8 plants in Australia banned from exporting to China. Of that 8, 3 are related to COVID, and 5 are all about the fact that they had, you might say, labelling issues. There were technical problems that led to their ban. And that China does that often. But the clear message is that we're not alone. As you can see, 90 plants globally have been banned. Yet if you were to believe the media, it's all about picking on Australia. But that's not the truth. The fact is, we're just one of many, many countries that have had bans. So spare a thought for Canada, 11 bans, and that makes up 70% of their pork production that suddenly cannot go to China. And then you've got Argentina, 14, the UK, 8, and the list goes on. Now, during this period, a number of these countries have been fortunate enough to have relistings. So the Chinese government is trying to relist people. So 38 have been relisted during that period, of which Australia has had none, nor has Canada. And the net result is that there are 52 plants now who still cannot ship to China, of which we still have 8 out of 52. My point here is we are not alone in this space. And there's no doubt politics is playing a huge role in what's going on here. So that's the problem when talking of offshore and the fact that China is saying, if you've got COVID in any of your plants, you cannot ship to our country. But let's now talk about onshore. It's a whole different set of things going on. You may or may not be aware, but every load of meat going into China is tested for COVID-19. And that's led to lots of backing up imports in China. It's chaos at those various ports, as you can imagine, testing hundreds and hundreds of thousands, millions of product every day. So here are the results as of 3 months ago. You had 57 total number of positives, 25 in seafood, beef 16, 12 in pork, and 4 in chicken. Roll the camera forward, and today it's 85 positives total globally since they started testing 6 months ago. So that means 85 plants from where that product came from have also been banned, either for a week or a month, depending on what they decide. That's in addition to the 90 that I showed you earlier. That's separate. And here are all the countries in which the various bans of product have occurred. And my point here is that when you look at the delistings overseas that occur separately versus what's found internally, they're very different. So there's no doubt that politics is playing a role. So why are they testing so much for COVID in China? It's because that's how the disease came into China. Didn't you know that? It wasn't Wuhan. It came in on frozen meat. And the World Health Organization 2 weeks ago published the findings of Wuhan. And at the end of it, they said Wuhan is not responsible, but there was a footnote. And the footnote said there is a possibility that frozen beef is the cause of COVID-19. So there you have it. It really is an enormous effort that takes away the blame from the Chinese government. And truly, that is what's going on. And we are suffering in terms of just global trade because of this. changing gears again. So as I said, the start of this, I just picked all the topics that I thought mattered, that really influenced what was going on. And to that gentleman's question earlier on, this is a big part of understanding what went on in pricing over the last year or so. So here is the import pie chart of China, of beef. Brazil makes up 49% of China's imports. Argentina, 22%. Australia, a mere 7%. New Zealand, 6%. And Uruguay, 10%. So between Argentina and Brazil, 71%. And just to keep in mind, China 3 years ago was Australia's #1 market, and we shipped that year 300,000 tonnes. So it just shows you how big these other countries are and the enormous volumes going into China, and we only make up a mere 7%. So let's talk about Brazil and Argentina and what's gone on. So here are the Argentina beef exports out of their country. And this is since 2018 on a monthly basis. But you can see here that in December, the volume out of Argentina into China fell dramatically by 35%. And during the last year or so, we had this period of extraordinary beef exports from Argentina into China. The rest down here are all the other countries that they export to Argentina. In actual fact, 70% of all Argentinian beef has been going to China. That's an enormous reliance on one market. And when we look at Brazil, it's a similar story. Here is China in the red, and here are all the other markets down below. And in the month of January, the volume fell dramatically by 32%. And once again, over the last year or two, they've been exporting an enormous amount into China. In actual fact, the requirement to sell beef from Brazil into China, it was 30 months and younger animals only. So for the slaughterhouse to export to China, they had to turn around to the producer, and they required 30 months and younger only. So what happened was that they got all the steers that they required, 30 months and younger, and exported them all to China. And then they ran out of steers, so they went to the heifers, and they started killing all the 30 months and younger heifers because the prices were so good. And let's be honest, their economies, Brazil and Argentina, are pretty bad. And I'll show you later, the Brazilian real, the Argentinian peso collapsed, fell during this period. They became so cheap that they just kept selling and selling and selling. They sold the family farm, and now they've run out of meat. And for the next 2 years, the exports out of Argentina and Brazil will be depleted considerably, globally, because of 2 years of selling the family farm. They were banking the money, and it was good. Record prices for them. They were loving it. But unfortunately, they have no more. The cupboard is empty. And now let's talk about buffalo, because it too, out of India, has played a really important role in China, but it goes through the grey channel. So in the past, the grey channel has been Vietnam. But 6 months ago, due to politics or whatever, there happens to be some islands off Vietnam that they're fighting over, they switched to Hong Kong. And so Hong Kong was taking about 55,000 tonnes a month and smuggling it into China through the grey channel. It's been a huge market. And for India, only 3 years ago, 700,000 tonnes in 2017 went from India, of buffalo, into China. 700,000 tonnes. I'm just telling you, India plays a crucial role within China in filling that protein void. And now it's collapsed. In actual fact, shipments of buffalo fell 70%. And do you know why? Because of Brazil. So Brazil was to be exporting into Egypt, into all these other parts of the world. They've run out of cows, they've run out of steers, they've run out of heifers, they've run out of everything. Suddenly, Egypt needed the meat. And what did they do? They turned to India, to buffalo. And now, today, Egypt is the #1 market for the last 2 months out of India for buffalo. Egypt is the #1 market. And the meat has been diverted away from China into Egypt. So now we're starting to paint a pretty interesting picture. Brazil's exports have fallen, Argentina's exports have fallen, India buffalo exports have fallen. Things are starting to tighten up. And there's been a loss of 7 to 8 million sows. It's getting tighter, much tighter. So here's the imported prices into China of beef. And you can see since 2019 December that the market has fallen dramatically. It's actually fallen 29%. And that was because Argentina and Brazil kept selling and selling and selling into the market. And it collapsed the price all the way down to around about November last year, to rock bottom levels. And Australia, on our grinding meat, on our lean meat, on our commodity frozen meat, was dragged down with it. And as a result, it's impacted our pricing, and I can show you later today, particularly on cows. So let's put over the top of that the global meat price. And it shows you firstly here, so that's chicken, beef, pork, all wrapped up in one price index. And the FAO, Food and Agricultural Organisation, monitor it. And you can see a fairly tight relationship between the value of imported beef into China and the value of global meat, full stop. It just shows you how important China is in determining global meat prices, in particular the commodity end. And this is the commodity end. So you've seen here now that in recent months it started to lift up. And I can tell you that already China and that tightness of supply is starting to have an impact. And in the last week or two, it's lifted by about 10%. So I expect that when the figures come out eventually, you'll see that following up that global price index. As a result of that tightening supplies out of South America. So here's the way I'd like to try and explain it. So you've got two markets going on at once. You've got here at the top is what I call the high-end global beef price. And it's really Australia's grain-fed beef and US grain-fed beef, and I've combined their value together. That is the high end of the market. And you can see that here in that's December 2019, here we hit COVID, and effectively the commodity end here, this is the cheap Brazilian, Argentinian and 90cl from Australia, the grinding meat market. It's all got caught up in that avalanche of Argentinian and Brazilian beef, and it dragged prices down. And then we got COVID and it dragged it even further. We had a slight rebound because America got carried away with itself, and then suddenly there was more COVID occurring. But during that whole time, the high end held together. It was remarkable. It truly is, because most of us in the trade thought the world's going to collapse, not just on the commodity end, but on the high end. And for a brief moment in Australia in April last year, it did dip. But it was March actually, but it was all but brief. And that was because people got really uncertain, and in particular Wagyu suffered in that brief moment, but it only lasted about a month, and suddenly it was back off to the races. So in terms of operators, in terms of meat processors, they actually made money on long-term grain-fed programs last year. A lot of it was related to the fact that if you've got a 150-day animal, you've bought it 150 days ago when it was a lot cheaper than today. As you know, prices have gone higher. And Wagyu, 365 days. You bought it 365 days before. So by the time it comes through here, doing pretty well in this up market, you've got a cheap input cost in a rising market. The problem down here is that we had this collapse, and cow prices in Australia went up and global cow prices fell. So grass-fed for the last year has been a living nightmare for processors in Australia. They've lost anywhere between $250 to $350 a head. It's been problematic, but the grain high-end sector has done reasonably well. So, as I explained, we've had two different markets, and that commodity end fell 28%, and we've since had an 11% rise since December 2019 in the high end, and today it's a 21% fall, all during this COVID period. So let's look at global cattle prices, and Australia still sits at the top. We've got an average price that sits 13% higher than North America and 46% higher than Brazil and Argentinian prices. It does make our life very difficult to be competitive globally. So other key factors to watch: La Nina, bird flu, US hit safeguard, foreign exchange, and the super commodity cycle, whatever that means. So, La Nina. So I don't need to tell you what it means in Australia, La Nina. I was lucky to get out of Taree. It's wet. It's really wet. And just when the Bureau of Meteorology said, well, we think La Nina's breaking down and it's not really going to have a big influence, it didn't stop raining after they said it. And it's been raining ever since. So what happens though is when it's wet here, it's dry in North America and South America. And so this is something we need to keep an eye on. They can't liquidate any more cattle. They've pretty well done that, the Argentinians and the Brazilians. But what it will influence is possibly grain prices, because there will be crops that fail or just simply don't yield as well as they should be. So there will be an impact as we move forward, and if should this persist, on grain prices. And in North America, through this whole cattle region here, that is the worst of the drought today. And you will see potentially some liquidation in cows. It hasn't started yet, but it's once again something to watch. Bird flu. So just as an example, in Japan this week, 77,000 chickens were euthanized, culled, because of bird flu. And so far, it's appeared in 17 out of 47 prefectures across all of Japan. And so far, they've culled 10 million birds over the last 6 months. It's a lot. But interestingly, what's been the impact on demand? Well, in South Korea and Japan, it hasn't been an impact yet. But I say yet. In actual fact, during COVID, the demand for chicken in those two countries went up, just simply because people were eating at home and a lot more fresh chicken was bought to be cooked and eaten at home. And therefore, it's had a far greater impact so far than the impact of bird flu. But this is how it works. So these are the flyways of the birds, the migratory birds around the world. And at the top here, during the summer months, they congregate together and they're quite gregarious. They enjoy each other's company. And should the disease or any diseases be had, that is when they're spread amongst themselves during the northern summer in the North Pole. And then as the winter comes, they all fly south. And in the flying ways here, whether it's across Europe, whether it's across the Americas or wherever, and through Asia, they carry the diseases and they drop bombs, disease bombs, otherwise known as bird shit. And that's how it's spread through all these countries. And in actual fact, it's 37 countries right now. And at some point, this is going to have an impact, I believe, on chicken demand. And if we're talking 10 million birds in Japan, I think we're talking hundreds of millions of birds globally that have been euthanized. And today, or this week, in China, there's been one death due to H5N8. And that is what is really going to make the world nervous, is when we start getting, it's a different, slightly different strain, but we start getting deaths because of bird flu, human deaths. I can bet your bottom dollar that consumption starts to fall dramatically if we start getting deaths around the world. So just be careful, watch this space, because this disease is not going away for the moment. Japan hikes tariffs on US beef. So, Donald Trump, in his wisdom, pulled out of TPP, if you remember. And we remained with TPP. And when he decided to do that, he was trying to get tariffs at the same level as Australia. We once had a 5% advantage over the US into Japan on beef. But when he pulled away and signed a new agreement, he managed to get the same tariff. Huge win. But in actual fact, it was a false win, because his safeguard level was terrible. In actual fact, it was only 233,000. Excuse me, Brent. So, that is a very small amount of access for the US. In actual fact, it's about what they ship normally every year. And if you ship to that level and trigger the safeguard, suddenly your duty goes from 25.8% to 38.5%. It jumps more than 13%. And suddenly it gets very costly as a Japanese importer to bring in US beef, as opposed to Australian beef. Thank you. So you can tell that now it suddenly gets interesting. It's a comparative advantage that we've got into Japan for beef over our biggest rival, America. And remember, we share 90% of the market between Australia and America. So for the next 30 days, once that's triggered, and it only happened in the last few days, this thing now jumps to 38.5%, the tariff for them. And there will be a scramble, I think, for Australian beef, just in this small window to help fill the void. So, because it's so much cheaper to buy Australian beef, even though we're at record levels on cattle, but you still look for the best prices you can no matter what. So, opportunities for Australian exporters will be limited because it is a small window, but somewhat there. But also is that the problem for US exporters going ahead is that every year they will trigger that safeguard. And therefore, the ability to grow that market is incredibly limited for the next 11 years, thanks to Donald Trump. So there you have it. That's a comparative advantage. And we have got access of in excess of 430,000 tonnes with a few other countries, but we do not have this problem. Now we'll talk about currencies. And once again, this matters. So currency changes. So here's the stimulus package that was introduced last year in March. $2 trillion. And what happened during that period? Well, the Australian dollar jumped 17%. The New Zealand dollar up 13%, the Chinese yuan up 7%, the Canadian up 4.5%. But here's the killer. The Brazilian real fell 15%. So in actual fact, their advantage over us is 32.5%. Why is that? We went up 17, they fell 15.2. No wonder they were doing so well into China. It's so damn cheap, their currency. And it made us incredibly uncompetitive. And I showed you the 35% drop into China last year. This is a big reason why. We just can't compete when people's currencies are collapsing. But it gets worse. The peso dropped 28%. And in actual fact, it's close to 45% difference between the Aussie dollar and the peso. It's near impossible to compete with. So, as I said, currencies matter. And now we've introduced another 1.9 trillion package in the last week in North America. What will that do? So, let me make a couple of key notes here. It should be noted that 37% of all US dollars ever printed in the world of the US dollar for the last 80 years or whatever, that all occurred last year in 2020. 37% of all US dollars were printed last year in the USA. No wonder the world is awash with US currency. Should the Aussie dollar rise another 17% due to another, $1.9 trillion of stimulus, it now then would put the Aussie dollar in a year's time at 90 cents. It kind of makes life difficult. And then when comparing stimulus packages to the global financial crisis, 2008 and 9, it was 4.5 times difference in terms of spending today compared to back then. That was before this week's announcement, or last week's, on the additional 1.9 trillion. So it's 9 times difference of stimulus packages now being spent today compared to the global financial crisis. 9 times more money in stimulus packages has been spent. So, I just did a fascinating interview between 2 foreign exchange experts, and both very learned men. One of them, and I just at the start thought, this is going to be a really boring interview. They're both going to totally agree, and I'm just going to be sick of it halfway through. Well, it was the complete opposite. One of them said, we're going to 90 cents for all the reasons I've just pretty well outlined. And the other one said, we're not. We're going to 70 cents and below in a year's time. One was at 90, the other's below 70 cents. How could they be so different and yet such learned men when it comes to foreign exchange? And yet I believe the guy who's talking about 70 cents. And he believes the real issue is going to be China. And the fact that there are headwinds in China that they have not really made obvious to the rest of the world, but debt is a huge issue. And we saw in the last few weeks that the Aussie dollar tried to get through 80 cents. And in the last 5 years, it cannot and has not got through 80 cents. It's tried and it's failed. And the other interesting thing is that we've seen that the Aussie dollar and the equity markets, the Dow, followed each other and had a 97% correlation for an entire year. And in the last 4 to 5 weeks, that has dislocated. The Dow's gone up and the Aussie's fallen. And to this other learned friend who said below 70, he said, that is one of the many indicators to me that we are not going to 90 cents. So just keep it in mind that even the most professional FX experts, foreign exchange experts, have hugely differing opinions. The super commodity cycle. So let's first of all try to define what a super commodity cycle is. That is when the world contracts in terms of production, in terms of output, because of problems. For example, COVID-19, in which industry shut down. We saw, manufacturing really shrink, and then suddenly the world starts to get better. And the ability to respond to increased demand sees prices go through the roof. And that's what we've already started seeing. So here, pork bellies are at 120% higher year on year. Hot rolled steel is up 103% year on year. Natural gas is up 58%, soybeans 54%, hogs are up 37%, the list goes on. Now, are we really in a super commodity cycle? I don't know. But the last time it happened was 1998, and the upside of it lasted in 2012. And then it fell from there. And it was over within another 5 or 6 years. But most super commodity cycles last anywhere between 10 to 30 years. And with that, inflation goes up, prices of all commodities go much, much higher, and with that, the value of meat and the value of lamb will potentially rise if we are at the start of a super commodity cycle. The Australian herd and sheep rebuild. So after this section, we're going to stop for a cup of tea. So let's just talk about whether the Australian herd has stopped liquidating. Of course it has. But really, at what point in the rebuild are we at? And this is a question that ABARE and MLA, our two forecasting organisations, I think are struggling with enormously. And I don't blame them because the figures are incredibly misleading. And I'm about to tell you how and why and a way in which we, as I believe, should interpret the data. But without knowing at what stage we are in the rebuild, we will not know when or if cattle prices are about to peak. What size will the herd grow to? Well, if you still think we're liquidating, how the hell can you predict herd size? What production will do for the next 4 years, and also all these other key stuff like feedlot capacity, exports, carcass weights. Understanding where we are in the cattle cycle is critical. And I'm about to show you some of the confusing data that's occurred in the last 12 months. So, right up here is the female ratio of kill. And at the moment, last June, it was at 55%. And in the next quarter's data, it came out at 53%. And this dotted line here is 47%. That is the ratio at 47%, where females make up total kill at 47%. And if you should kill at that point of equilibrium, and if females go above it, in terms of their proportion, the herd is in liquidation. And if you should fall below that ratio, the herd is rebuilding. It kind of makes sense. So, less females are being killed, they're being held back, and they're producing more calves, and the herd is growing. Above that, they're killing more females than they have time. The ones remaining are being outstripped by the ones being slaughtered. So the liquidation occurs when the ratio is above 47%. Okay? But for the last year, it's sat at somewhere between 53 and 55%. That would mean that we're still liquidating, and yet, does that require more rain to stop that? I don't think so. I think in reality, there's some other factors influencing it. And the rebuild has commenced. So what's pushed that needle? What has made the needle go from what should be below 47% to sit above 50% to 53 to 55%? What is that needle doing? Well, there are two main factors, I think, that have pushed the needle. One is live cattle exports, and two, the Australian dairy herd. So, here's what live cattle exports look like. This is since 1993, and all through this period, up until 2014, at 1 million head, we tended to be below. But after 2014, the herd, the live cattle exports, started to become a real business, a serious business. 1.3 million shipped out, 1.1, 1.3, and in last year it was about 1 million head. And where we exported them to were two key markets, was Vietnam and Indonesia. Indonesia is the blue line, Vietnam is the orange. And they pretty well dominate the live cattle export trade. So to ship to Vietnam, it requires 90 to 95% of the cattle to be male. And to ship to Indonesia, it requires 80 to 85% of the cattle to be male. And in actual fact, even when you take into account breeding stock that go as well, almost 80% or more of all cattle leaving Australia is going out male. So suddenly you've got about 1 million head of male disappearing out of the country that effectively leaves the other mirror of the 1 million head female back in the country. So that's going to lift the ratio of the female kill because there's a lot more females left behind. So to me, this actually has added somewhere between 2 to 4% of that female kill. That's pushed that needle that bit higher. And in actual fact, the better way to look at it is to say that when those cattle get to the port, let's pretend their heads have been chopped off, and that they should be included in the overall slaughterings. In actual fact, let's just call them disappearance. Slaughterings plus live cattle exports, because now you've got a true picture of what the disappearance is. So you've got to remove that noise from the statistics. So now let's look at the impact of the dairy herd. So here in the blue is the last serious liquidation that occurred in the dairy herd in Australia. And I use the Victorian numbers because the bulk of Australia's dairy herd is in Victoria. And you can see that during the liquidation of 2005 to 11, the blue, that once it gets up to here, 70% of the kill in Victoria was female. 70%. And in this current liquidation that was going on, I put that over the top and it mirrored it almost exactly, showing that we were in a true liquidation of the dairy industry in Australia. And in actual fact, there's a lot of females being killed that are dairy cows that are impacting the slaughter data. And in actual fact, the peak was in May in terms of liquidation of dairy cattle in Australia, and in January, 2 months ago, they came out of liquidation. So no wonder the needle has been tampered with, because in actual fact, to me, that pretty well is another 3 or 4%. So now, let's remove the noise. Let's look at the disappearance. Let's take into account the males that have gone out as live. Let's take out the dairy influence, and let's just get back to the beef herd and what's going on. And so here is really the situation where the beef herd, in actual fact, stopped liquidating in January last year. It just happened to be when the rain came. What a novel idea. You stop liquidating when the rain comes. And you can see that it hugs the dotted line for 6 to 8 months. And why do you think that is? Well, let's talk about how a drought breaks. Rain falls here, it falls here, and a month later it falls here, and here, and here, and at the end of 6 months, it's fallen everywhere on the eastern seaboard. And it takes 6 to 8 months for the drought to break. And that's what that dotted line is, that we are not liquidating, we're not rebuilding, we're in a, you might say, a holding pattern as the drought breaks for 6 to 8 months. So let's then look at what other droughts have done. So this is a rebuild back in 2014 to 17, whereby we learn from other, I guess, drought-breaking periods and moving into rebuilds. And once again, back in 2014 to 17, we saw the drought break. And in that period, we saw that period of in the holding pattern. The rain fell and it hugged the line for 6 months or more. And then eventually, it went into the rebuild. And I call that, it started its earnest rebuild at that point in time. And no different to us. As we go into the month of September, October, Australia went into deep rebuild, and that's when it started, the rebuild, in around September, October last year. So suddenly the figures, I think, are making sense. And once you understand that when the rebuild started, we can now start talking about when the peak in pricing is likely to occur. Because after every rebuild, when it starts in earnest, within 3 to 4 months, peak in pricing occurs. This occurred in 2004. The pricing peaked in September, 3 or 4 months after the rebuild started. In 2016, the same happened within 3 to 4 months of the rebuild commencing. And this year it's 2021. So it happened slightly later. But nonetheless, I think the prices have peaked. And then in 2011, it occurred in December. So now we're trying to pull apart the things that really matter to me. And once you've understood why the figures sat at 53%, 55%, but we removed the noise, and today I can say with confidence, we are truly rebuilding, and we stopped liquidating last January. But in the eyes of ABARE and MLA, they're still scratching their head. Now ABARE, in all fairness, I did explain this to them. And as a result, they put me on at the Outlook conference to give a presentation. So I was rewarded for my information. Though I never spoke of this, I spoke of African Swine Fever. So this is a regular drought. The beef herd has started rebuilding. It commenced, it stopped liquidating in January, and it started to rebuild in September. And as I said, the dairy herd only stopped liquidating 2 months ago. So we need to break it down to what it truly is going on out there. So, this is not to be a time to pick on MLA, but I'm going to do it anyway, all right? So, this may or may not look familiar to some, but this came out about a month ago. And this is their prediction of where the herd is going to go to, okay? So they've got on the left-hand side here the size of the herd going back to 2000. And what they've done is here is 2019-20, and the herd is roughly at 24.5 million. It's pretty low. The issue I've got is that they've mixed up 2 sets of data here. And they've confused the hell out of really what's going on. So when you measure herd size, the ABS, They go out to the farmers and they ask, how much money, income did you earn? And if you earned prior to 2016 more than $5,000 on your farm due to cattle, they counted your number of animals you've got. And then after 2016, in their wisdom, they said, we're now going to lift that threshold to $40,000. That as long as you've earned more than $40,000, we're going to start counting your cattle. So, whatever happened to the cattle below 40,000? They disappeared? I don't think so. But unfortunately, MLA have mixed two sets of data. They've put the 5,000 EVAO against the 40,000 EVAO. And what's the difference? I can show you now. It's 2 million head of cattle. 2 million head of cattle have not been accounted for in that analysis work, I don't know, whatever you want to call it. In actual fact, between 5,000 and 40,000, there are 2 million head of cattle owned by farmers around Australia that earn an income in that $5,000 to $40,000 range. And that magically disappeared. Well, it's there. So my point is that in actual fact, MLA's figure is probably closer to 26.5 million in terms of where the herd got to last year. If you take into account the missing 2 million head, and if you work off one EVAO only value of 5,000, which is what I like to do because I think that 2 million head are important. So the MLA forecast had a 2% increase to 25.2 million in 2021. My belief is it will be a 7.5% increase and we will get to 28.3 million head. That's a big difference. So why is it so different? One, I think I've worked out that we stopped liquidating. Their figures, they're still very unclear about it, and they say that in their writing because they simply didn't understand the noise that was going on. And two, 2 million head of cattle were missing in their figures. So in reality, their figures should really say they're 27.2 million to begin with. So, as I said, I love the MLA because I need them just as much as you do. But it's really important to me that we understand and we work with the figures that are correct. We don't mix up two completely different sets of data and try and make them look as one. So here are my forecasts for the size of the herd. I've got last year falling to 26.3 million, which if you account for MLA's mistake, they're pretty well at the same number. The difference is that I truly believe that the foot is to the floor in terms of the rebuild, that the accelerator is down and the joinings are at their absolute highest. And the lack of females in the market is a clear indicator of that. So I'm expecting a 7.5% rise, and that by 2024-25, the herd to get to 29.4 million head. Now, that might seem like a dramatic number, but if you look at 2010, we were at 26.5 million compared to 26.3. There's not much difference. And we got to 29.3 million in 2013. And I'm saying we're going to get to 29.4. My point is, we've been here before. This growth is nothing new. And I think, for all the reasons I've talked about the lack of protein, particularly globally, but in China, that the market will absorb 29.4 million head of cattle. So, a regular drought, this is nothing new. The flock size. So I'm also a great believer that the herd and the flock have moved in tandem together since 2010. And why 2010? Well, we saw the flock back in the early 90s, I think was around about 160 million head, thanks to the floor price scheme, if you remember. And then, since then, it's fallen all the way down, and today sits at 64 million head or thereabouts. And to me, at 2010 is when it got into the 60s, and it truly started to reflect, I guess, demand and supply. The price signals for meat and weather signals in terms of drought and rain started to be reflected in how the flock tended to move, no different to the cattle herd. In actual fact, they were responding in a similar way.
20 years later.
What do you mean?
The floor price got finished in 91.
Yeah, and exactly. It took 20 years for the flock to come to a level that suddenly had some relevance, I think, to global markets. That overhang of that wool was on the flock up until 2010, and eventually it started to mirror the proper signals. And I think meat prices actually are playing a role in the size of the flock today. Mutton and lamb prices. So, it's my personal opinion, but if I can use cattle understanding, it helps me better understand the flock, because the information in the cattle sector is so much better. Tell me how many females were killed in the flock, slaughtered. We've got no idea. The wethers, the ewes, the lambs, they all just go in as one category, really. Lambs and sheep. We've got no idea about the data when it comes to the flock in terms of slaughterings, etc. Yet, I can read a lot in, as you can tell, into the cattle data. It helps me better predict things. So, all I'm saying is that I've watched them move in tandem, and by using the cattle market and its movements is helping me to make better decisions potentially about where the flock's going to go. So I'm expecting it to lift to potentially around 76 million head within the next 5 to 6 years. It's a big lift. But here's that number since the late 90s, 121, a 47% fall in the flock. It fell to last year 64 million, and as I said, 76.5 million. The sheep flock is therefore, I'm expecting to expand by 12.5 million. The lamb slaughter to be up 27%. MLA had a flock to expand by 10.7 million by 2023. So that's pretty well in line with my own in terms of 2 years prior to my forecast. So I've given them a star. Lucky them, all right? They go to the top of the class. So, what's so unique about this rebuild? Highest cattle prices ever, 8.88 cents. The lowest female retention on record, with Queensland in January at 25%, meaning they were just so scarce. Only 25% of the kill were females. And we've had falling global meat prices during this rebuild. Every other one saw rising meat prices. Global market uncertainty, a pandemic, China's political situation. Cattle prices have moved to record levels at a record rate. The acceleration to these higher prices have never been seen before, and there's been structural change to the Australian meat industry. We've had feedlots expand, we've had live cattle expand. And livestock producers are confident more than ever before, due to record low interest rates, due to amazing livestock prices, and due to high record land values. Effectively, grass fever is alive and well out there. So, let's quickly talk about the kill and its uniqueness here. So there you've got the current kill on the eastern seaboard of cattle. Up here are the last 3 previous rebuilds. That's not last year's kill. I've gone back and looked at every other rebuild. And normally during a rebuild, supply is tight as they're trying to rebuild and expand the herd. And we are 20% below any other previous rebuild. That's to show just how tight it really is. This is unique in that respect. And part of that, I believe, is related to an extraordinary event that happened in January 2019. If you remember, in northern Queensland, there were floods halfway through the drought. And in actual fact, 600,000 head of livestock were lost. And I can never recall in any other drought to have a flood that removed 600,000 head before. And you can imagine that on top of the losses during the drought, we took another 600,000 head out. And in actual fact, they were a really valuable 600,000 head because you didn't have a chance to hold back your good ones. The floodwaters just took the lot. Non-discretionary when it comes to flooding. They take it all. So to me, that is the X factor here. That to me has really seen these slaughterings at unusually low level, and I also think that we've had an unprecedented amount of rain along the eastern seaboard that's lasted now for 4 to 5 months. And we had a great year last year as well in other parts of Australia. So those two combined factors have seen this extraordinary situation. But I think things will turn around soon in terms of a rebuild. So here's the latest female kills, and we've now jumped to 34% in Queensland, and compared to 17 and 12 and even 2005, it's starting to come back into line. And overall, if you put the weighted average of Queensland and New South Wales, that female ratio is now looking very similar to previous rebuilds. So my point is that in the back end of this year, I expect the numbers will start to reflect a rebuild of old, and things will come back on track, and more numbers as the herd grows will start to appear. It won't be overwhelming. We're just going from extreme tightness to tightness, all right? But it will see, I think, cattle prices continue to fall. The difference is, how soft is the landing going to be? And we're going to talk about that after our tea break. But it will be a soft landing. So, 2 more slides. Has the drought broken? So, some of you may have tuned into my webinar in May last year, and I talked of this interesting relationship that I did. I looked at 120 years of data, of rainfall data, and I picked out the 9 driest years on record. All over that 120 years, I went for the 9 driest, and after every extreme dry year, the drought broke. Every time. So I averaged all those 9 years and came up with that orange situation there, that line. And then I put 2019 and 2020 over the top, thinking, well, is history going to repeat itself? And lo and behold, here it looks like. We've rolled the camera forward since May last year. And it's unbelievable how close it is in terms of the overall rainfall. It's extraordinary. So what have I done? By chance, without even knowing it, I think I've spotted 9 El Ninos, in which was dry and drought, that flipped into a La Nina, just like we've got this year. And by the fact that I found the 9 driest, I just went straight to the most extreme conditions and found 9 years over 120 years that truly does reflect today. So, being so clever as I am, trust me, this is just sheer luck. I then said, well, if I'm so damn good at this now, what's the next 4 to 5 years going to look like? All right, how long is the party going to go on for? So here it is. This is the prediction based on that 120 years of data. This year is a good wet season. Next year is expected, if we stay true to history, will also be a good wet season, an average but to good wet season. And that, though, we'll see at the end of 2022 a relatively poorer wet season. Nowhere near as bad as the drought, but it will be probably not as good as the previous 2 years. And then as we get into 2023, at the end of that, another better wet season, and then in 2024, another fantastic wet season that resembles this one. So I'm saying out of 5 years, 4 years will be very good, and 1 year in the middle, not so brilliantly good, but not so brilliantly bad. Just fair. And last night at one of the talks we gave, the guy said, well, we all know that. After every drought, we get 2 good years. Well, I'm saying 2 plus 2 is 4, with one not so good one in the middle. Anyway, with that, enjoy your cup of tea and we'll chat later on.
Thanks, Simon. I know it's not news, I'm assuming you've still got others there involved with because...
I think I'm back on. So, just to refresh your memory, I actually am in the market every day. So I'm not just an analyst. In actual fact, this takes up about 30% of my time. I am buying and selling meat on behalf of many others, and as I explained earlier, I'm in the swaps market, but I can say, to me, I really enjoy trying to bring, I guess, a market focus to my analysis. To me, I'd like to think that that separates me from the rest in terms of the analytical world, because not many of them have had skin in the game, understand what it's like to have a position on, understand what it's like to have the market collapse on you and trying to get out of a shitty deal. Or know when to sell in a rising market. All of that. And in meat, the world, it's no different to the livestock world in the sense of understanding or try to better understand how to do things better and make sure that you minimise your risk. So this session is trying to at least question, as I put the numbers up on various categories, you can all think hopefully about your own situation and what it does, if I'm right, in terms of pricing and where it moves, either up or down, what it means to your own position. So that's part of today, is trying to really let you self-analyse and think about how does this impact me if things should go the way he's talking about, all right? With that said, you need, this is a disclaimer, this is my personal opinion. You need to get further advice, talk to the experts, and get other professional advice before you make your own decisions, all right? This is just my personal views on what's going to happen. And there is a disclaimer at the end as well. But I wanted to say it right now, okay? So, stay with me. Let's review the last livestock forecast that I did. So back in 2018, November, how many of you were here? That's really bad. You're all going to remember, all right? And what about last May? Did people tune into my webinar? Okay, that's bad as well. All right, so what really happened? So back in 2018, I forecasted a 420, 3 scenarios. 420 hard landing in terms of the EYCI and where it would head to during that year. And if you remember, Brent, he's in the far room, but I also said the drought would go for another year. In reality, Brent, how long did the drought go for?
14 more months.
Right, I was out by 2. So, I had a hard landing at 405 in one scenario and 416 in the third scenario. So, somewhere between 405 and 420 was my thought process at the time, and I used 3 different methodologies. We don't need to go into those, but it's important to say, was I right or wrong? So, in reality, the ECI got to 390 in mid-March. I was 15 cents a kilo out. But remember, up here, the ECI at the time was 461. So I was not only talking about the lows, but later on we started to talk about the highs and where the ECI would end up. Where I did go wrong was you can see that I said it would occur in October and it didn't occur until 5 months later in March. So I wasn't bad on my pricing, but my timing was not brilliant. So last May, if those that tuned in remembered, and this was before we knew where prices are headed today, but we saw last May, or my prediction was, that we would get to 440 live weight or an 850 on the EYCI. That was in May. And I was kind of starting to second guess that I thought later on it might get to February, March, and I brought it forward to the peaking in October, November. And then if we flip back to 2.5 years ago, my forecast then was 800 cents per kilo and a February, March 21 high. So there's my two different forecasts. The first one was 800 cents 2.5 years ago, and it would peak February, March this year. Remember, it was 460 at the time when we were making this prediction, 2.5 years ago. And then I said, last year, hang on, it's going to go a little bit higher, but it's going to come a little bit earlier. Well, in reality, it's got to 888, and it occurred in the last week of January. Now, this may not still be the absolute high, because I've heard today the market's sitting back at about 875 as we speak because of this rain. And I can show you in coming up slides, there's no doubt we may revisit the 888, but I truly believe that we've really reached the top. We are part of a cycle, and these things happen. And I'm going to show you all the other cycles, the start and the finish. So, 440 back in May. In reality, what happened? Well, it got to 455, and it occurred, as I said, in January. And this week, as of last Friday, when I put these numbers together, it was at 440 cents per kilo. So I was probably a little bit short of the mark. My forecast was 440, and it actually got to 455. And it occurred, as we know, around, sorry, that should read January. It occurred about 4-5 months later. And here's where I see it heading to. I think it's going to be a slow, gradual fall on feeder steers, but in particular on lighter feeder steers, not heavy feeder steers, because I see heavy feeder steers as the vulnerable part of the market. So I expect that we'll see probably by about July, but August, September, the market eventually getting to around 400 cents per kilo on feeder steers. And then eventually, by November, December, to probably take another step down to 350. That's not uncommon, because normally you see the southerners come on and they tend to swamp the market in that final quarter, and prices tend to take a step down in most years. And I think this year will be no different. Okay, so a 350 in November, December. But honest to God, I see that. Some in the room may say 400 from, today's price at 440. But I think over the next 5 to 6 months, that is a fairly gradual fall. So last May, when we did discuss this on that webinar, I highlighted some key factors affecting the market. And I want to focus on feeder steers, because to me, we're using it as a little case study before we talk about the heavy steers, the cows, and all the other things, because the feeder steers are so important in the market. So the factors that mattered last year were feedlot demand, the COVID restrictions lifting globally, that hole in US supply. Do you remember when they absolutely collapsed in terms of their kill, because all the workers got sick and suddenly there was a hole and there was excess cattle and they kicked the can down the road? Do you remember that expression? Kicking the can down the road, pushing those extra cattle in America down the road because they just didn't want to deal with the problem now. So that was the other key issue, is that impact of that hole in supply. And then we had the Chinese New Year, the bounce back effect, and that IMF report we've already spoken of today. So today, those same factors that I listed, all 6, are just as important today as they were in May last year. And we're going to touch on a couple of them right now, plus a few more. Tightening of South American supply, we've already talked about, and a short-term easing in grain prices. So let's talk about the hole in that US supply and what really happened. So the market did absorb those extra cattle that were pushed because of the sick workers that occurred in that March-April period last year in America. And by the 4th quarter, they started to churn through those extra cattle. And in this quarter, the 1st quarter, they've already got through them as well. And in actual fact, that problem, to me, is behind us. And demand is in good shape. So much so that here we've got, looking at the live cattle futures, so this is the best indication in America what live cattle or cattle fed are going to do over the next 15 months. So here you've got June, a 7.5% increase in the value of fed cattle in America. And then we go up to the end of this year and April next year, a 15% increase. So why is that so important as us Australia? Because our number one competitor is America, and 12% of their production goes export and 88% stays in America. So when these prices go up, that's going to lift the value of US domestic meat. It will, it has to, because cattle numbers are going to be relatively tight compared to demand. So a 7.5% increase in the next 3 to 4 months, and then on top of that, a 15% increase overall by the end of this year and into next year. But that therefore means that they're going to lift their prices into Korea and into Japan. Why? Because their domestic market is forcing them. If the Japanese and the Koreans want to buy their meat, they've got to buy it away from the domestic market in America. And who's our number one competitor? 90% of both of those markets they share with Australia. So they lift their prices. What are we going to do? We're going to lift our prices. Why wouldn't you do anything different? Okay. So that was worrying. Let's switch to the feedlot sector in Australia. So the latest figures are sitting here at just over 1 million head. And it's my belief that, as I've explained today several times, that high-end part of the market, with the rebound effect, the high numbers we had on GDP, the 8% in China, the 5 to potentially 8% in America, that we're going to have strong demand for the high end of the market. And with that, I can see that the grain-fed feedlot capacity numbers will increase in Australia. And so much so, I think we're going to get close to record levels by the end of this year, which is a bullish statement given how tight cattle are today. Yet I think those numbers are already pretty damn full. I've spoken to the largest feedlotters in Queensland, and they're already full now. And the feedlots in New South Wales are on their way to being full. And I think, in actual fact, we've already taken a lot of that fullness in the market there into account in terms of the pricing you're seeing today. They have been chasing hard. So I'm believing that constant need for feedlot cattle, due to these terrific global prices, and remember, these are still expensive cattle to buy. They're still losing money to a certain extent on particularly the short-fed programs, not the long-fed. It's still a challenge. But nonetheless, it's the least amount of money that they're losing compared to grass-fed animals. They're highly incentivised to keep buying feeder steers, is my point, and expect that demand to continue. but I think it will be very selective where they're going to push in terms of demand. And I still think prices will fall. I just think that sweet spot of around 400 to 440 kilos for feeder steers will remain a highly sought after area. And some may say 380 to 400 is the sweet spot. It doesn't matter. 380 to 440, it's still going to be highly sought after. The real concern will be heavy feeder steers, and we'll talk about them. Over-fat feeder steers. This is the most vulnerable part of the market. As I said, the sweet spot is 400 to 440. Some grids, though, have taken 500 to 550. Now, the issue you've got is that certain customers are happy to take it by weight once they've been fed to a certain weight. But a significant part of the market insist on having 120 days, or they may insist on having 100 days or 150 days. But I can tell you that if you're putting it on at 550 or higher, and you'll stick to that 120 days, you're producing elephants. And it's hard to sell elephant parts. They tend to fall over the sides of the plate. They don't look that good. And that's my concern, is that you'll be producing elephants soon if you're not careful. And they are going to hit you hard if you overproduce, I think, on those feeder steers. And as the back end of the year, as I kept saying earlier, as we move into that more traditional rebuild and the numbers start to come forward as the herd expands, this is the concern. Heavier feeder steers could end up, if you're not careful, as Jap oxes. The price spread will widen. Being too fat will be penalised. So here I've got the spread between feeder steers in the orange, a medium steer, and a heavy steer. And right now, it's sitting at 50 cents a kilo between feeder steers and medium steers, and 76 cents a kilo with heavy steers. And I can see that widening as we move forward. So much so, I think medium steers could balloon out to $1 a kilo. And I can see that heavy steers will be discounted against feeder steers to $1.50. So from 73 cents to $1.50 less in price. That's the worrying area. And everyone's got green fever, and they just say, well, I'll just go and buy more cattle. And we'll put them, we'll tell them to the feedlots, if they're close to 600 kilos, who cares? Well, think long and hard about it. As we get past June, July, more and more cattle will come forward. The southerners will have some pretty damn heavy cattle. It's a good season down there. Just be careful. And an easing of grain prices. So this is a short-term phenomenon. And this is because I think of the African swine fever problem. So you're going to have this enormous loss in China. And what's been driving grain prices has been China. And I think we'll see that ease back for 6 months as they get themselves sorted. As the losses become more apparent, their need for grain diminishes in the short term. I think by about August, September, it'll bottom and they'll start to rebuild again, and the prices may move back up again. Plus, we could have the impact of La Nina and Argentina, Brazil starting to kick in as well. So, my expectation is a short-term fall in grain prices. And with that, that will give a lot of feedlotters thoughts about owning the sweet spot more and more. Highly incentivise them, because the conversion rate, the yield on those lighter animals is so much better than on the heavier animals. They go backwards in terms of the yield when they're buying those heavy feeder steers. So they will be incentivised to focus on the sweet spot, the 400 to 440, and that heavier steer they will want less of as grain prices fall. So just be careful that I think that falling grain prices may put pressure even more pressure on those heavier feeder steers. So here's the price on grain, and as I said, a short-term impact of falling prices before it bottoms in August and potentially goes higher. So here's my heavy steer forecast, and I'd predicted to have a peak of 382, and I overshot the mark, and in actual fact it got to a peak of 375, and today it sits at 367. And to me, this is probably likely to fall to around a 350 by about June. So I think we're a couple of months away, and I think it's going to be a relatively sharp fall to 350 and then slightly go sideways. But the big concern is the back end of the year. As I said, the Victorians, the Southerners, will start to bring the cattle forward. And I think we'll find around about a 12% fall further in the period of October, November, December. You do not want to accidentally end up in this space. So this year, last year the average was 343. This year, my expected average is 349. Pretty good number still. I think you can live with it. And here are the veal steers. And this is, to be honest, probably where I really fell on my face, okay? I had a peak of 458 in November. In reality, today it sits at 502. And it's got no sign of weakening as we speak. But everyone wants a bit of that younger animal today in the market. They're clamouring for it. So I'm expecting, particularly with this rain, that it will move sideways for probably the next 4 weeks, maybe 6 weeks, and then it will be a gradual fall for the balance of the year. And in actual fact, I've got it falling here to around about 370, but if it was a $4 or $4.20 fall, it wouldn't surprise me in December. I'm telling you, this is the softest landing of all, because those are so genuinely tight in the market. So last year the average was 398, and this year the average I'm expecting is 450. It's a pretty healthy number as well. And here's the cow forecast. So I had a peak of 344 in October, November. Last May I made this. And in reality, it's been a great disappointment. Cows have really not responded the way I thought they would have. We got to a peak of 295. And the only reason I can really give for why that occurred is because of Argentina and Brazil. Because this truly reflects that commodity end of the market that got overwhelmed by cheap Brazilian, Argentinian beef last year. And it never quite got to where it should have because the global commodity market collapsed. And so to me, it was a disappointing year for cows, given what I thought other previous rebuilds had done before. And today it sits at around 280. And my expectation is it's quickly going to fall in line with where my forecasts have been. And I think we'll see probably close to 250 for the rest of the year, with a little dip here in June of about 233, but just let's call it 250 for the rest of the year. What's so interesting about this, and so many people have said to me in the last 4 days or 3 days, so what do I do? You know, should I buy this? Should I buy that? Well, of all the items, this is potentially the least amount of risk, only because it never got to the dizzy heights it should have. And now the fall, well, it's pretty well going to fall back into line with where I think it should anyway. There's not much more downside is my point. And in actual fact, if you're a good buyer of cows, you're probably going to do pretty well, buying them at the right level, selling them at the right price. As I said, this potentially is one of the least risk areas today in the market, simply because there's not too much further to fall, I don't think. So the average last year, 263, this year, 256 cents per kilo live weight. So a summary of the cattle situation. So cattle cycles occur. And here we are in today's cattle cycle. And as you can see, there was the previous one back in 2016 when it peaked. And here we've got 2009 to 13, 2002 to 6, and 1998 to 2002. They start and they finish. And what's remarkable is that eventually they come down as the numbers build. The difference is that this is, I believe, a soft landing. And here's the previous cycle. So all I've done is I've lined up indexes to make them look a lot more clearer. And as you can see, there's a start and there's a finish. And they normally go from anywhere between 210 weeks to 230 weeks each time. So why is it back in 2018, I came out with a forecast saying that February, March would be the high? Who predicts 2.5 years out? Well, you just got to look at the cattle cycle and work out where you're in it. And you've got a fairly good starting point on trying to get some, I think, reasonable estimates on the table. And eventually, the market finds itself. As the cattle expand, the herd expands, and dare I say, the marketplace sorts itself out. And so here's the outlook I've got for the next 12 to 18 months in terms of pricing. And I'm saying that this current cattle cycle will finish in April 2023. And at that point in time, we will be at 535. So write that down now, because I look forward to 2 years' time when we can talk about this and see how close I am in my forecast. The point being is that this current cycle is worth around 665 cents per kilo on average, and the previous one was 546. It's 22% higher today than any other previous cattle cycle. The overall average value is 22% higher. You can take that to the bank. So I think we are in this space, and when we get to the end of March 2000 or April 2023, we'll start the next cycle. And I can tell you that we will revisit the levels that you're seeing today in the next cattle cycle. You've just got to go through that 220 weeks of the cycle as it starts and finishes again. So here's an outline of the ECI against global beef prices. And what's so important about this is that it gives you a little understanding of why things are doing what they're doing today. So see those triangles there? What do they represent? The dotted line is the value of the ECI in US dollars, and the blue line is global beef prices. It's really Australia and US high-end beef prices. Well, that dotted line, that triangle, is losses. They are losses that processors are now experiencing and always have during these periods where cattle prices are much higher than global beef prices. And why is that? It's because the rebuild's on, because there's green fever out there, there's restockers, and you're paying a lot higher price for cattle today than what the real global markets are doing. And eventually, sanity prevails, the herd builds, and we go back to levels that are in line with global beef prices. I've shown you today, though, that global beef prices are improving, and it will be a soft landing when eventually you come in line with global beef prices. So that triangle is particularly large this time round. And that's because processors have probably lost more in this rebuild than ever before, in any other rebuild. So I think the size of that matters. And they've been losing money probably since January last year and won't stop losing till October this year. That's a long period. So we need our processors. as equally they need you. So, on to sheep meat forecasts. So here's the world according to Simon Quilty when it comes to understanding lamb prices. Because what determines lamb prices? Is it just by magic that they are at these levels? It's not by magic. To me, lamb has always competed in the high-end part of the meat industry, the high end. So that's where grain-fed beef, chilled, lamb exists in that same space. And they actually are competing with each other at a global level in supermarkets and places all over the world. So to understand what lamb is going to do, to me, you've got to understand what global high-end beef values are going to do. So here is, since 2016 in particular, the value of Australian lamb exports against high-value beef globally. And as you can see, it's a pretty tight correlation. And it's been moving higher, along with lamb. And so this is the same graph again, but I've taken out all the bumps and averaged it, and effectively, lamb prices have been particularly strong. But we've had periods of time where it's exceeded the global beef price, and other periods where it's been below. So let's talk about how and why that may occur. But before we do, so is it the lamb that's determining beef prices, or is it the beef prices that determine lamb? Anyone in the room? Exactly. The tail does not wag the dog. And what do I mean by that? Well, imagine the sheep meat being the tail and the dog being beef. Lamb is not determining beef. The tail is not wagging the dog, it's the other way around. You've got 15 million tonnes per year being produced of sheep meat. You've got 70 million tonnes of beef being produced. I can tell you now, beef is driving lamb prices at that very high end. The tail does not wag the dog. So, this explains to you, in the middle is the global meat price. Here is heavy lambs, and here is production. And as you can tell, when production is high, it's that the lamb prices sit below that global meat price. But in certain seasons, when lamb production falls, it sits above the price. It just simply moves around it, depending on what the season is like in production on lamb. And I'm of the opinion that because of that extraordinary situation where those three sectors have been out of the market on lamb for so long, and now they're going to come back in due to COVID-19 vaccination, plus we've built new land markets. It's been an extraordinary story. We're going to see lamb, I think, hold above global beef prices for several years. It truly is a great story about lamb. So here are my lamb forecasts. Today the market sits at about 8.06 cents per kilo. My blue there was the forecast I made in May last year. And here, unfortunately, due to COVID, it was a disaster. We got nervous, the market, the airlines, everything closed, but then the retail sector in America fought back, and today at 8.06, I think we're going to get to my 8.80 that I originally thought. Lamb is back on track. And that's my forecast for July. To me, for all the reasons that I've said, lamb looks great, and I think we'll peak at 8.80 this year. We may even go slightly higher. And I think it looks better and better each year forward from here. And here is my forecast on mutton. I had last year the peak at 765, and this year the peak to be 755. In reality, once again, COVID struck again in the mutton sector and took away, I think, what would have been a good year for you on mutton. But here again, we're at 636, and I think we will get to my forecast of 758 in July, August this year. Once again, the market is recovering fast. Vaccinations are going out there. We've got GDP globally going to jump to 5.5%. The story's a good one. So, trends of 2021 and beyond. I see an expanding Australian herd to 29.4 million. I see the sheep flock expanding to 76 million. I see a flight to quality in Wagyu, in Angus, but in Hereford, in all the breeds. I see a need to get to the quality end of the market, to get out of the way of Brazil and Argentina. We have a stay of execution for 3 years, and COVID-19 is underway. US cattle prices and beef prices will rise, which will help Australian beef and lamb prices going forward. La Nina could persist. Wet in Australia, dry in North and South America. Global corn and grain prices to eventually move higher. A short-term dip between now and August, and then as their recovery improves, as problems potentially persist in Argentina and Brazil, expect them to move higher into next year. Australian cattle prices will fall, potentially a moderate fall, 10 to 15% this year, another 8 to 12% next year, with most of it occurring in that last quarter of each year. This cattle cycle will be 22% higher in value than any other previous cattle cycle. Well, Australian lamb prices to move higher with grain-fed beef prices, and Brazil and Argentina may contract. Their exports may get less, but it will eventually expand after 2 to 3 years. As I said, it's a stay of execution, but we need to get out of their way. We do not want to be in the commodity end of the market with that for much too longer, or the bare minimum there. US continues to be Australia's largest competitor, and there's my disclaimer. And thank you for today.